Part 4 of the stock market update. Where are we? On the FTSE 100. Sometimes it kisses its moving average and moves up, this MACD, so it might fall and rise. I'm not that optimistic. Telegraph, have British fund managers become a pointless expense for investors? Yes, they have. DIY savers pay 115 million a year in fees, but 10 billion in funds unable to beat the average. That's your pension. That's why you're screwed. Not just because inheritance tax is going to now apply to your pension as well going forward. I think it's 2027 onwards. Worst fund managers take $500 million of fees from investors. It's a Telegraph. It's been going on and on for years. That's why you need to be empowered. You need to get hold of this. Well, be part of the Great Investments Program, that you can get hold of this. So you've got the knowledge and the empowerment. But more importantly, I'll give you the bespoke one-to-one education so you can use it. If you get a 10% rise on $500,000, that's 50 grand you've made. Okay? Let alone, it's for life. We don't charge subscriptions, weekly, monthly, annual. So we just do a one-off. And update it every month. Top 10 S&P 500 stocks. These are they. Let's have a look at these. See if we're missing anything. See how we might do the investment structuring on these. Okay, and before I do, let me just show you this. This is the performance of the S&P UK in pounds. That's basically, think of it like the FTSE, but because it's Standard & Poor's and they're a competitor to the Financial Times stock exchange company, they call it they've got a separate measure, but it does measure the same bloody thing. Versus the S&P 500, which is the 500 largest US stocks in sterling terms. So that's the US market, S&P 500 in sterling terms. So much for currency risk. I'm whinging about that. And that's the S&P. That's basically the FTSE, the UK market. So the UK market's in yellow. You're buggered, and that's the US ones. It's up to you, but personally, I can see why I invest in the US markets. If you invest in the US markets, the data shows you're getting far greater returns. I'm not going for 11. I'm going for a hell of a lot more than that. That's in sterling terms, okay? If you're going to do the UK markets, well, you're going to get almost half that. Actually, I get 5% from my bank, 4.8 from my bank. So bloody hell, seriously? Now, there is a way. Of course, you get less volatility. This is what the scaredy cat IFAs pension funds want to sell you on. No, keep putting it in UK. We'll add a little bit of US. If you do this, you'll reduce your volatility. Okay, how much the portfolio moves up and down, and you will move further up here. Personally, I can handle the volatility. I'd rather be up there, and I cherry pick out of the S&P 500, which allows me to do a lot better than that. Plus, I use leverage. I mean, to be fair, okay, look, I cheat. If I use 3 times leverage S&P 500, then I'm going to get 33%, aren't I? It's cheating. That's in rough terms. Don't use leverage unless you understand it. In any event, 7.1 million tracks the S&P 500. That's how much money tracks the S&P 500. There's a lot of money going in. Ain't that many people tracking the FTSE? Aside from that, do you know what 7.1 million represents? That's double the size of the UK economy. That's double the size of the UK economy, is how much tracks the S&P 500. Now, let's have a look at some of those big rises, see if any of these are interesting. I appreciate that the banks have got a load of buys on this. I know on my value growth income, it ticks the minimum box of being a 9. However, it is not a special situation because it's not oversold. It'd really have to be in a position a lot lower down for it to rise. This is not that. So how could you do it outside of the program? Well, if you agree that that would be the direction of travel, and you might not, based on historic trend moves, you might say, nah, it's too optimistic. You'd probably put a stop loss somewhere here. And so you would say multiple upside to downside, stop loss down there. It's not a trade I'm going to do, not an investment I'm going to do. You'd hold for 12 months for that return, but you'd have a fixed stop loss at that point. Why at that point? Well, if you put it down here, it'd be pointless. If you put it here, it's going to get hit by just the market noise. So that's the nearest point you can put it, which you would know that if the price is going to do this, it would have no business going all the way down here. You could put it a bit lower, being there. So you've got multiple upside to downside, and you'd work out that were it to hit this point, the amount of money you'd have put in this investment is such that you wouldn't lose more than 1% of your portfolio if it did hit that stop loss. Okay, simple as that. That's one way to structure it. I'm just giving you many different ways, but I'm just giving you one. Palantir doesn't have value growth income of 7, 8, 9, or 10 for us, therefore it's not in the Great Investments Program. Outside of the program, well, if you agree with that projection, then based on what I said in the last slide, you probably put a stop loss there. Now you know how to structure the investment. You know the holding period, you know the reward, you know the risk, you know the downside, you know how much capital to put in. Boom, everything's worked out for you. It's not part of the program because it's not value growth 7, 8, or 9. So you can see we are more stringent than anything. This is a 7, but it doesn't count as a special situation because that's not risen. That's too overbought. So the upside is limited. But if you disagree and you think that's going to go all the way there based on the current trend projections, then you'd probably put your stop loss somewhere like this. Well, maybe a bit higher, maybe there. And do the calculations like last time. GE Vernova, again, high risk. I mean, it's just an IPO. We've hardly got any data, so it's clearly not in the Great Investments program, but just shows you what we're looking at. That'd be the projection. I guess your stop loss would be there. Carnival, not in the program because it's not 7, 8, or 9, and it's overbought anyway. But if you wanted to do that as an investment over that period and you believe that trend could hit, like I said, it's not in our program. Wouldn't be one I'd do. There's the stop loss. You'd put it there and you get multiple upside to downside. Part 5 I will do in a separate broadcast. Oh, by the way, have a look at alpeshpatel.com/links. Like and follow for more and look at the links in the bio.